Welcome to the Stockscores Market Minutes for February 13th, 2012. This week's topic, find opportunity in fear. But before I get into that, reminder you can subscribe to my free weekly newsletter at the address on screen, stockscores.com/newsletters.asp. All right, let's get into the topic for the week. Fear and uncertainty cause investors to accept prices that are too low. The market will often misprice assets that have the potential for a major negative event, even if the potential is very, very minor. For example, let's talk about Apple. For a long time, the market knew that Steve Jobs' health was poor, and Apple probably didn't perform as well as it could because there was this discount being applied in the instance that Steve Jobs would die. Now, Steve Jobs died October 5th. That was right about there. And for the next couple of months, the stock kind of didn't do anything. And then the earnings started to come out. People started to realize that, hey, this company is doing fine without Mr. Jobs. And it is now playing catch up to really where it should have been a long time ago, based on its earnings multiple. Now, moving to the market example, uncertainty and fear are easing in the overall stock market as Europe comes out of its difficulties. Since December 20th, the market has been going up because uncertainty and fear about Europe are easing. Now, it's not necessarily that business fundamentals are improving, although we do see some sign of that as well. What we are seeing is simply the removal of the fear discount in the overall market. Now, I would not say that the process is done yet. Money is still hiding in safe assets like U.S. Treasuries. I'll show you that in a moment. Basically, the long-term money is not yet coming back to the market with enthusiasm. Traders really remain the driver of the market right now. They are willing to make trades, but they're not really committed to that long-term turnaround. And so we see a fair bit of volatility. We've had a good short-term run, but it has been on light volume. Now here I have a chart of the U.S. 20-year bond ETF, symbol TLT. And you can see that over the last 4 or 5 months, this has been sort of locked in this sideways trading range. Now, going back farther, this thing was moving up well, and that was because fearful money was moving into the safety of treasuries. So we've seen this market going sideways. It started to drift down a little bit, but it really hasn't broken down. And when you consider the gains that the stock market has made in the last 6 weeks, we would expect that money would be coming out of the safety of treasuries and into the stock market. And that's not really been the case. So that tells us that that big money is still sitting on the sidelines. Now, turning our attention to the VXX ETF, which is representative of the VIX index, often called the fear index. Here we can see that we've had a nice downward trend. Fear has been coming out of the market. That's a good way to look at that. In the last 3 or 4 days, we've seen a break of that. And that was because there was some uncertainty about whether Greece would get their austerity package approved by its government. And I don't think that's still totally clear yet, although certainly the market is indicating that it believes that the problems in Greece are coming to some sort of solution. So we've seen fear come out of the market, but we're not yet seeing the big money come back. The market has gone up because fear has been taken out. Now what the market needs is that catalyst to bring that big money back to the market. The U.S. equity markets have come back to where they were before fear took over. We're basically now, and I'll show you this in a chart in a moment, we're back to the prices that we saw in May, or April, I suppose. The market really started to sell off in May, and that's now been erased. We've come back and taken back all of the lost value from that sell-off that began in May. Now the attention is going to turn to the fundamentals. Is the economy actually getting better? And remember, the market looks forward. It doesn't look backward. And so we don't need to think about what has been happening. It's more a question of, will the economy get better in the future? Now we should expect sideways trading while the market contemplates that question. And it makes a little bit more sense when we look at the chart of the market itself. Here's a chart of the S&P 500. And here you can see that the market has really rallied nicely in the last few weeks. And we're back to the prices we were at before fear took over. So here's fear taking over. And we've come back to that. I expect now that this market is going to move sideways here until we can get some catalyst for the market to break higher. Now we'll return to the idea of catalysts in a moment, but I want to talk a little bit about the Canadian market because it is a bit different than the U.S. market. The Canadian market is really driven by commodity prices, which are ultimately driven by the U.S. dollar. If the U.S. dollar goes down, we expect that commodity prices will go up. Investors are growing optimistic that commodity prices are going to go up as the US dollar goes down, but they're not yet committed on that. We haven't seen a real strong break on the Canadian market yet. So we want to watch for that, an upside break out of the current trading range, because that will imply that the market expects the US dollar to go down, and we'll talk about why in just a second. Here we have our chart of the Canadian dollar, and you can see that it really hasn't fared as well as the US market. I mean, it's come back in the last 6 weeks as well, but it is stuck underneath that resistance from November as opposed to getting all the way back to where it was in May. Now what's encouraging is that the bottoms are rising from left to right, and that is a sign that the buyers are growing optimistic about Canada. I expect this market will kind of wind its way in the tip of this pattern, and if it gets a catalyst for a break in mostly commodity stocks, we're going to see this market move higher. The key is what happens with the US dollar. Now I think there are two potential catalysts for a break higher in the market. First is some expectation that the economy is getting better, and we're starting to see some signs of that. Unemployment is coming down in the US, retail sales are improving, but certainly we're not out of the woods. We're just getting better. The other thing that the market is now looking for is some stimulus from the US Federal Reserve. We've heard this referred to as quantitative easing 3. And if the US Fed can come in and do some quantitative easing, you're going to see that market break higher. Certainly it has in the past. I like to watch the chart of oil because it's a good indicator of how the global economy is doing. And we can see here that oil is really stuck inside a trading range that it's been in for the last few months. What's encouraging, however, is that pattern is optimistic. We can say it's optimistic because the bottoms are rising as we move from left to right. But until we get a breakout through the top of that pattern, we shouldn't get too excited about oil. Now, if we get a break like that, then we can assume that the market globally, or the economy globally, is starting to improve. Now, turning our attention to gold, this is a good chart as a representation of what the market expects for stimulus from the US Federal Reserve. If the US Fed starts to stimulate the economy, essentially they're printing more money, and that devalues the US dollar, and we tend to see the gold prices go up when that happens. Now, gold was in a downward trend up until about a month ago. It broke that, and in doing so, it also held the really long-term upward trend line. If we drew a 5-year chart, you would see how it bounced exactly off of that really long-term upward trend line. So right now the market is a little bit undecided. We're stuck in this little narrow range over here, and until we break out from that range, I don't think we should get too optimistic about gold and, of course, a declining US dollar. But if we get that break to the upside, then I expect things to go higher. Everything right now seems to be in a holding pattern, but there is optimism into that holding pattern. So to summarize my outlook then, in the near term anyway, I am neutral on just about everything. US, Canadian stocks, gold, and oil. They all seem destined to be in a little bit of a sideways trading range here. But I think that really it's the market's taking a seasonal break. Now February is one of, historically, the weakest months of the stock market. Right now we're just looking for the market to reconcile its recent gains. Investors are really looking for that fundamental catalyst to move stocks up. Fear's coming out. Now we need something to make people want to buy, make money come out of those US treasuries and into the market. Downside risk is relatively limited. I don't see any real reason to be too fearful that we're going to see a major sell-off because we haven't really seen a major gain where we've got a bubble that is bursting. Well, that has been the Stockscores market analysis for February 13th, 2012. Have a great week in the market and trade well.